Have you ever wondered what you're going to do if you're running the wheel strategy and the price of the stock you're running the wheel on goes so far down low that you can't sell cover calls for any decent premium? I think this is one of the biggest fears that people have before they run the wheel strategy, and they just don't know what they can do to, I guess, attack the position. And here's a strategy that I like to use if I'm running the wheel strategy in order to make sure that I don't get a flat tire that I can't fix. So, first off, as usual, I'm not a financial advisor. This is just for informational and educational purposes. Do not take this as financial advice. uh, so the scenario is that you sold a put on a stock that you don't mind owning, and you got to put the shares. I mean, it happens. The next step of the wheel is to sell covered calls, but what do you do if the share price drops so low that selling a covered call above your cost basis or your assigned price is not something that you can do for any significant premium? Well, the answer is to run this strategy. I like to call it the attack in the wheel strategy or fix the flat. So before implementing this strategy, like some questions you have to ask yourself: do you still believe in this stock? One of the first things you want to think about when you're managing a trade is to make sure that you still want to be in that position. Sometimes it's better just to close out the position, move on to something else. So if you actually like the stock and you don't mind holding it long term or mind the exposure to owning those shares, okay. Next question that you can go to then: do you still want to own the shares when trying to fix the shares? If the answer to that is yes, move on to the next question: are you okay with more exposure to the shares? So ideally, this is a stock that you didn't mind owning at the price that you sold your original put for. So you got to sign at that price. Are you okay with buying more if this price continues to drop? If the answer is yes, then you can use this to really attack that position. So my example, this is a trade that I'm actually dealing with right now. I sold 3 puts that expired this week at the 22 strike on PLTR. PLTR is currently trading at, what was it, $18 or so? And I will most likely be put these shares at, I'll be buying them for 22 bucks a share. Now, I collected 82 cents premium on this, so my adjusted cost basis is $21.18. Some people like to include that when they're thinking about their trades and how to manage them. I usually don't. I only include like the last premium I collected on my trades for the most part. And in this example, that would be the last premium I collected for this trade, so my cost basis is $21.18. Oh, the share price is $18.96 right now, so it is below. It's like $3 below. And this means I'm down about $2.22 per share. That's pretty significant on a $20 stock. Now, normally when I'm running this strategy, I'll be looking at 30 to 45 DTE contracts because I'm a very passive trader. So just throw it out there, let data do its thing. But for this example, to really illustrate how this works, I'm going to be looking at a weekly contract because 1890 or whatever the current start price is not too far below that the 30 to 40 day contract is worth chasing right now. But if you're looking at the weekly, it really showcases how this can help you lower your cost basis quickly when otherwise you'd not be able to. So in this example, my cost basis was $21.18. So selling a covered call above that would mean that I have to sell it at $21.50. If we go to the $21.50 strike, if I go to the $21.50 strike, I would only collect 10 cents or $10 total premium for selling this contract. I don't know about you, but to me, that's not really worth capping the shares. Like $10 is not really going to adjust this position that much. All it's going to do is cap my potential gains for very minimal credit. So that's not something I would want to do until we look at doing this plan. So the plan is very simple. Assuming you're okay with buying more shares of the stock, you can go ahead and sell 30 Delta puts for the same amount of contracts. Once you have that, you can now sell cover calls at the assigned price that you got put the shares, or your adjusted cost basis, or your new adjusted cost basis with the premium for the puts factored in. Because overall, I view this as one giant trade. As long as it comes out with a profit, that's awesome. Now, looking at this, if I was to sell the 30 Delta put, here's the Delta 28 close enough to 30, I would collect 34 cents. We'll take the middle there, and that's the last price. So there's the 34 cents. I can also now sell that covered call for 10 cents. And now I'm collecting 44 cents instead of 10 cents. And 44 cents collected on a $20 stock is actually pretty significant. Now this will reduce my cost basis, or my adjusted cost basis, by 44 cents instead of 10. So now my new adjusted cost basis would be $20.74 instead of $21.08 if I only sold the covered call. Now this slide has a lot of text on it, but we'll get through it, and I think it'll make it very clear what happens here. So using that example for all these numbers, if the stock price is below the put that I sold, I purchased more shares, and my cost basis for this position is now $19.37. And I got to that because you're going to be combining your position from the new put that you sold and the covered call that you had. So the shares that I am accumulating now from the puts that expired in the money, I sold those at 18 strike. I collected 34 cents. My original position, my cost basis was $21.18, and I collected 10 cents on the covered call. Add that all up, divide by 2 because I'm doing equal size contracts. And that's how I got to the $19.37. So now instead of having 300 shares at $21.08 if I just sold the covered calls, my new position is 600 shares at $19.37, which again is hopefully closer to where the current price is, so I can still sell covered calls. And if I started small, I can redo the strategy as many times as I want to keep attacking this position, assuming I started trading small. If I start with 1 contract and I do this, I'm now up to 2 contracts worth. I could do it again, be up to 4 contracts. But because I started with 3, I can't continually double because I'm already at 3. After this would be 6 contracts. So this is why I always say, like, trade small. It gives you room to manipulate stuff by taking advantage of all the strategies that you learn. Now, in my case, I like having a no assignment strategy, so I don't really like holding stock too much. So ideally, the stock price would move above the covered call strike for me. And the result is that the puts expire worthless, so that 34 cents that I got for selling those puts is in my pocket. The covered call gets exercised, and I lose the shares. So I'd be selling these shares at $21.50. My cost basis was $21.18. It looks like I did some math wrong there. That's awesome. So that's 32 cents, not 30 cents. And then the premium I collected overall from this trade is 44. So it actually makes $72 per share. And because I have 300 shares, that's going to be a little over $210, $206 I think it is, or sorry, $216 of profit for putting on this position. Now if I only sold the covered call at $21.50 to begin with, then I only made the $32 per share. That'd be about half the profit that I got for doing this entire strategy. If the stock finishes between the put and the call, then the puts expire worthless, the calls expire worthless, and I end up with my 300 shares and a new cost basis of $21.74. That's a lot better than $21.18 because, as you saw from the strikes, I can lower my strikes automatically from doing that. And ideally, I just keep running this strategy until my shares do get called away. So like I said, I like to look at the monthly cycles because I'm a more passive trader. You get more premiums that just sit there and cook away. So in this example, going back to my actual position here with PLTR, I'd be looking at selling the 30 delta put, which would be right here. Here's the delta, 28. And I'd collect about 60 cents credit for doing that. Now, I can go ahead and take my adjusted cost basis, subtract that 60 cents now, and I see my call just has to be above 20.58 to be a profitable trade if it gets breached to the upside. Now, in this example, I'll probably be looking at the 20.50 or the 20 strike, but let's look at the 20.50. Oh, but Thumper, you said it has to be above that. Well, remember, at this strike, I'm collecting a pretty hefty credit. I'm collecting about maybe 60 cents, maybe 62. So if you take the difference here of 8 cents, subtract that from that, there should be still a 52-cent profit if my cover call gets breached. So you don't always have to sell above your cost basis or your adjusted cost basis if the premium that you collect from doing this trade puts you over that mark anyway. So in this example, I collect hopefully about $52 per contract, and if this gets breached, then I made $150 managing this wheel that went flat. And basically, how you choose to strike here is just a matter of how bullish or bearish are you on this position. Like, do you really want to get out of the position? If so, then sell closer to the money calls. If you don't mind holding it long term and running the strategy longer, you can still sell the 2150, have a higher chance of not getting the shares called away, and then you still be reducing your cost basis by the 60 cents plus 40 cents, so like $1 for just doing it. So just think on yourself, like with your portfolio, do you really want to get rid of the shares? If so, you can go close to the money. You make less profit for this trade, but you increase your chances of getting the shares called away and freeing up the capital for other trades. Or are you trying to maximize your profit for this position? It's just find that balance for you, but using that delta of like 30 to collect that premium, it really gives you more options on how to manage this broken wheel. Now, if I only had one contract, I kind of went over this already in the previous slide, is that I might be selling closer to in-the-money calls to get rid of the shares. And that's just a personal preference of how fast you want to get out of this position. And that pretty much sums up the whole strategy. The takeaway, determine if you still want to be in the position. I say this with every trade management strategy is, do you still want to be in this position? Is your original trade thesis correct? Are you okay with the exposure that the stock puts to you? So the first question you should always ask yourself is, do I still want exposure to this position? If the answer is no, then just close it down and move on to something else. You don't need to defend losing trades just so you don't have a loss on your books. Like, it really doesn't matter. Move on to more profitable positions and start printing some more. Using this strategy, if you're okay with upping your exposure to that position, because if it goes wrong and the stock continues to go down, you're buying more shares at these put prices. So are you okay with expanding your exposure to this position in your portfolio? If you're trading small, you have room to do it, so sure, maybe you are. If you started big with like 10 contracts and that's half your portfolio, then no, you probably shouldn't do this. Depending on your sentiment, you can sell closer calls to attempt to get the shares called away quicker or not, up to you. And then obviously you want to sub to one of the best option channels on YouTube, so click that subscribe button below, and I hope you guys learned something new from the strategy. I know this has saved me a couple times, and I just love this strategy. So far, it's always worked for me. Obviously, one of the downside risks to this is if the stock plummets down to zero, like you're just adding more exposure to that position by selling puts, where you're picking up more shares of the stock. This is why this is a strategy that you should only do on stocks that you are okay with holding long term, or that you don't mind buying the shares of. If the price skyrockets, obviously the cover calls that you're selling limit your upside exposure. But then again, for me, I want to get out of the position as quickly as possible so I can start selling puts, because that's the part of the wheel I love to be in. Thank you for watching, guys. I hope you learned something, and see you tomorrow.